Ever wondered why your gold investments aren't living up to your expectations? It could be due to some common mistakes that investors make. When it comes to investing in gold, the allure of this precious metal can often blind us to the finer details that can make or break our investment. We're talking about the common pitfalls that can turn a promising gold investment sour. These are the mistakes that, if avoided, can help safeguard your investment and ensure it grows steadily over time. Whether it's the lack of proper research, over-investing, or ignoring the importance of storage and security, these common mistakes can be detrimental to your gold investment strategy. So, if you're looking to invest in gold, or if you're already invested and want to maximize your returns, it's essential to be aware of these potential blunders. Stay tuned as we delve into these common gold investment mistakes. Rushing headfirst into gold investment is our first common mistake: lack of research. In the world of investment, gold often shines brightest in the eyes of the hopeful. Its allure is undeniable, it's tangible, it's beautiful, and it's been a symbol of wealth and power for millennia. But like any investment, it requires a keen sense of understanding and a healthy dose of research before diving in. So, why is research so crucial? Well, let's think of it this way. Would you walk into a new city without a map or a guide? Probably not. The same principle applies to gold investment. Without proper research, you're essentially navigating in the dark, susceptible to potential risks and pitfalls that could have been avoided. Consider this. The gold market isn't always as glitters. It fluctuates, influenced by a myriad of factors from global economic health, inflation rates, to geopolitical uncertainties. Understanding these elements can help you predict potential market shifts and make informed decisions. Moreover, research isn't just about market trends. It's about knowing your gold, too. Are you investing in bullion coins, bars, or perhaps exchange-traded funds? Each comes with its own set of parameters, and knowing the difference can mean the difference between profit and loss. And let's not forget about the seller. In the age of digital transactions, it's easy to fall prey to unscrupulous traders. Thorough research can help you identify reputable dealers, ensuring that you're buying genuine gold at a fair price. Now, you might be thinking, that sounds like a lot of work, and you're right, it is. But consider the alternative. A lack of research could lead to costly mistakes, financial losses, and a whole lot of regret. Investing in gold isn't a get-rich-quick scheme. It's a strategic move that requires patience, understanding, and yes, research. It's about being prepared, being informed, and being ready to make smart decisions. So, before you take that leap of faith, take a step back. Spend some time to understand the market, know your gold, and identify reputable sellers. Remember, an informed investor is a successful investor. The second common mistake is over-investing in gold. Now, you may be wondering what's wrong with investing a substantial amount in a shiny, valuable asset like gold. Well, let's delve into that. Imagine this. You've got a basket of eggs. Would you put all your eggs in one basket? That's a risky move, right? The same principle applies to investing. Placing too much of your money into gold at the expense of other investments is like putting all your eggs in one basket. Gold is a high-value asset, yes, but it is also subject to market fluctuations just like any other investment. When you overinvest in gold, you expose yourself to unnecessary risk if the market takes a downturn. While gold is often considered a safe haven during economic volatility, it's not immune to price drops. Moreover, gold does not generate passive income. Unlike stocks or real estate, gold doesn't provide dividends or rental income. It's a dormant asset that requires a rise in price to generate a return on investment. So what's the solution? Diversification. This is not about spreading your investments thin, but rather creating a balanced portfolio. Diversification involves spreading your investments across different asset classes such as stocks, bonds, real estate, and yes, gold. Think of it as a financial buffet. You wouldn't fill your plate with just one type of dish, would you? You'd want a mix of flavors to make your meal more enjoyable. Similarly, a diversified portfolio gives you a mix of investments, reducing risk and potentially enhancing returns. Remember, gold should be a part of your investment portfolio, not the whole of it. It's a means to hedge against inflation and economic uncertainty, but it shouldn't overshadow other promising investment opportunities. Investing is a marathon, not a sprint. It's about long-term gains, not short-term wins. So, don't rush into pouring all your money into gold. Take time to understand your financial goals, assess your risk tolerance, and make informed decisions. A well-balanced portfolio is key to successful investing. It's all about balance, folks. Don't put all your eggs in one basket, diversify, and you'll be well on your way to a more secure financial future. Ignoring storage and security is our third common mistake in gold investment. This error, often overlooked, can have serious consequences. Let's understand why. When you invest in physical gold, you're not only buying a precious metal, but also a responsibility. The responsibility of keeping it safe. Gold, as we know, is a valuable and highly sought-after asset. This makes it a potential target for theft. Neglecting the security aspects of your gold investment is akin to leaving your house doors wide open. It's an invitation for trouble. Think about it. You wouldn't leave your car unlocked in a public parking lot, would you? The same principle applies to your gold investments. Safe storage isn't just about having a place to keep your gold, it's about having a secure place. A place where your investment is protected from not only theft, but also damage. Gold may be a sturdy metal, but it's not indestructible. It can get scratched, dented, or even tarnished. Improper storage conditions can lead to such physical damage, reducing the value of your investment. A secure storage ensures that your gold remains in its best condition, preserving its worth. However, secure storage doesn't necessarily mean a home safe or a hidden compartment in your basement. Many investors opt for professional storage facilities. These facilities, often provided by banks or specialized companies, offer high-security storage solutions for your gold, complete with insurance coverage. It's like a vault for your investment, monitored and guarded round the clock. Now you might think, but that sounds expensive. Well, it's not as costly as losing your investment to theft or damage. The cost of secure storage is an investment in itself, a safeguard for your gold. It's the price you pay for peace of mind. Remember, gold investment isn't just about buying and selling. It's about preserving and protecting your asset. Ignoring storage and security can undermine the very purpose of your investment, turning your golden opportunity into a costly mistake. Security should never be an afterthought when investing in gold. It's an integral part of the investment process, a crucial step that ensures the safety and longevity of your asset. Our fourth common mistake is buying gold at high prices. Let's dive into why this is a pitfall you definitely want to sidestep. Now, we all understand that gold is a valuable commodity. Its allure has held strong for centuries, symbolizing wealth and prosperity. But just like any investment, it's not just about what you buy, but when and at what price you buy it. In the world of gold investment, timing is everything. People often rush to buy gold when prices are high, driven by the fear of missing out or the belief that prices will continue to rise indefinitely. This approach, however, can lead to significant losses if the market takes a downturn. When prices are high, the market is often in a state of overexuberance. This is when people are willing to pay more than the intrinsic value of gold, fueled by speculation rather than fundamentals. However, as history has shown us, what goes up must eventually come down. When the market corrects itself, those who bought at inflated prices often find themselves in a tight spot. So how do you avoid this mistake? The answer lies in understanding the market cycles and having the patience to wait for the right opportunity. Gold prices fluctuate due to a variety of factors, including economic conditions, geopolitical tensions, and market sentiment. By keeping an eye on these factors and understanding their impact on gold prices, you can make more informed decisions about when to buy. Remember, the goal is not to buy gold at its absolute lowest price. That's nearly impossible to predict. Instead, aim to buy when prices are reasonable, based on your understanding of market conditions and trends. Buying at a fair price, rather than at the peak, provides a safety cushion in case prices drop. In conclusion, don't let the glitter of gold blind you to the realities of the market. Buying gold at high prices can be a risky move, potentially leading to financial disappointment. Instead, aim for strategic, well-timed purchases. After all, timing and price are crucial in gold investment. Lastly, the fifth common mistake is selling gold in panic. When the market fluctuates, it's crucial to stay cool and collected. Just as a ship's captain must weather the storm, so must an investor weather market turbulence. You see, selling gold in a panic can lead to regrettable decisions. It's like jumping off a roller coaster mid-ride because of the scary dips and turns. The thrill is in the ride, not in the abrupt and dangerous exit. When you sell in panic, you might miss out on potential profits when the market recovers. Remember, the value of gold has historically trended upward over the long term. The market is a fickle beast, prone to bouts of volatility, but it's important not to let these temporary downturns cloud your judgment. It's about the bigger picture, the long game. So the next time you feel the itch to sell in panic, take a deep breath, reassess, And remember, patience is a virtue in gold investment. Let's recap the 5 common mistakes in gold investment. The first pitfall we discussed was the lack of research. Remember, knowledge is power. Equip yourself with the right information before diving into gold investments. Second, we highlighted the dangers of overinvesting. Always diversify your portfolio for a balanced investment approach. Mistake 3 was ignoring storage and security. Your gold is worth nothing if it's not safe and secure. Fourth, we pointed out the error of buying at high prices. The golden rule is to buy low and sell high. Lastly, we talked about the 5th mistake, selling in panic. Keep a cool head and make informed decisions during volatile market conditions. In summary, successful gold investment is about doing your homework, investing wisely, ensuring safety, buying at the right time, and selling with a clear mind. Avoid these mistakes, and you're on your way to successful gold investment. Thanks for watching.